You've got $100,000. Not monopoly money, not maybe someday money. Real adult, this could change my life money. And instead of letting it sit in a savings account doing absolutely nothing except getting quietly eaten alive by inflation, you start asking the question most people never stop long enough to ask. What's the smartest way to invest this without turning investing into a second job? You don't want to day trade. You don't want to stare at charts all night. You don't want to pretend you suddenly understand candlestick patterns. You just want your money to work. Consistently, quietly, relentlessly. That's where this video comes in. I'm Jack, and today I'm walking you through 5 Fidelity index funds that could realistically turn a $100,000 investment into something much bigger over time. Not overnight riches, not lottery nonsense. Real, historically grounded growth using boring, powerful, proven strategies that wealthy investors quietly rely on. We'll go from solid and defensive to aggressive and growth-heavy. And by the end, you'll see why one specific Fidelity fund has historically had the potential to turn long-term patience into truly life-changing numbers. Fund number 5, FSTA Consumer Staples. Let's start with something calm before we crank the engine. Number 5 is the Fidelity MSCI, Consumer Staples Index ETF, ticker FSTA. This fund is about as exciting as toothpaste, toilet paper, and groceries, which is exactly why it works. Consumer staples are the things people buy no matter what's happening in the economy. Recession, boom, panic, euphoria, doesn't matter. People still eat, clean their homes, and buy basic household goods. That's what this fund owns. The companies inside FSTA include names everyone recognizes: Walmart, Costco, Procter & Gamble, Coca-Cola. These aren't flashy businesses. They're cash machines that have survived wars, recessions, market crashes, and entire generations of economic cycles. Right now, FSTA pays a dividend of a little over 2%. That's not headline grabbing, but it's reliable. And more importantly, those dividends have historically grown over time. This is the kind of fund that doesn't make you rich quickly, but it does something more important. It helps you stay invested when markets get ugly. When everything else feels chaotic, consumer staples tend to fall less and recover faster. Historically, funds in this category have delivered mid-single to high single-digit annual returns over long periods. That may not sound sexy, but compounding doesn't care about sexy. It cares about consistency. If someone put $100,000 into a fund like this and let it compound over decades, they're not just preserving wealth. They're quietly building it year after year while sleeping very well at night. Fund number 4, FDIS, Consumer Discretionary. Now let's take one step up the risk ladder. Number 4 is the Fidelity MSCI Consumer Discretionary Index ETF, ticker FDIS. This is where spending gets fun. Consumer discretionary stocks are the things people buy when they feel good about money. New homes, renovations, vacations, restaurants, electronics, cars, all the nice-to-have stuff. When the economy is strong and people are confident, this sector can absolutely fly. FDIS holds companies like Amazon, Tesla, and Home Depot. Businesses that grow alongside consumer optimism. When people have extra cash, these companies feel it immediately. The dividend yield here is much lower than consumer staples, usually under 1%. That's because this fund isn't trying to be an income machine. It's trying to grow. Historically, consumer discretionary as a sector has delivered strong long-term returns, especially during economic expansions. It's more volatile. It falls harder during recessions. But over time, it has rewarded patience. If someone invested $100,000 into a fund like FDIS and stayed invested through the ups and downs, the long-term compounding could meaningfully outperform more defensive sectors. You just have to be emotionally prepared for rough years along the way. This fund is for investors who understand that volatility is the price of higher potential returns. Fund number 3, FHLC Healthcare. Next up is a sector that almost everyone underestimates. Number 3 is the Fidelity MSCI Healthcare Index ETF, ticker FHLC. Healthcare is one of the most quietly powerful areas of the market. People don't stop needing medical care during recessions. They don't cancel prescriptions when interest rates rise. Demand is persistent, and in many cases growing as populations age. FHLC owns a broad basket of healthcare giants: pharmaceutical companies, insurance providers, medical device manufacturers. The kinds of businesses that generate steady cash flow while still benefiting from innovation. The dividend yield here is modest, but the growth has historically been stronger than people expect. Healthcare often sits in that sweet spot between defense and growth. It tends to fall less than the broader market during downturns, while still participating meaningfully in long-term market gains. Over long periods, healthcare index funds have delivered returns that rival or beat the overall market, with less gut-wrenching volatility. For a $100,000 investor, this kind of fund can play a powerful role as a stabilizer that still compounds aggressively over time. Fund number 2, ONEQ, NASDAQ Composite. Now we move into the growth engines. Number 2 is the Fidelity NASDAQ Composite Index ETF, ticker ONEQ. This fund tracks the entire NASDAQ composite, which means thousands of companies, heavily weighted toward technology, innovation, and growth. This isn't just the biggest tech names. It includes established giants and smaller companies that could become the next giants. Historically, the NASDAQ has outperformed the broader market during periods of technological advancement. From 2010 through 2020, the NASDAQ delivered eye-watering average annual returns compared to the S&P 500. ONEQ doesn't focus on dividends, it focuses on growth, and historically it's been very good at that. If someone invested $100,000 into a NASDAQ-focused fund and simply held it over long periods, the compounding effect could be enormous. Not because of clever timing, but because innovation has been one of the strongest wealth-creating forces in modern history. This fund will be volatile. There will be years where it drops hard. But historically, investors who stayed invested were rewarded for their patience. Fund number 1, FTEC, Information Technology. And finally, the most aggressive option on the list. Number 1 is the Fidelity MSCI Information Technology Index ETF, ticker FTEC. This is a pure play on technology. Nearly everything in the fund is tech-related: software, semiconductors, cloud computing, artificial intelligence, digital infrastructure. The stuff powering the modern economy. FTEC holds the giants: Apple, Microsoft, Nvidia. These companies don't just ride growth, they define it. The dividend is small, which is normal for tech. Most of the profits get reinvested into expansion instead of payouts. Historically, that trade-off has paid off through strong total returns. Over long periods, technology has been one of the best performing sectors in the market. And when you give compounding decades to work, the results can start to look unreal. A $100,000 investment in a tech-heavy index fund held long enough could historically grow into several $1,000,000. Not because of luck or genius, but because compounding plus innovation is a powerful combination. As long as you stay patient and don't panic when markets do what they always do. Now, here's where most people mess this up when they actually try to do it. They overthink the allocation. You don't need a PhD in finance to split up $100,000. There's no single perfect mix anyway. What matters is using a framework that fits your life. If you're younger and you've got decades ahead of you, you can afford to be aggressive. You might put 70% into FTEC and ONEQ, then spread the remaining 30% across healthcare and consumer funds. You're leaning into growth because time is your biggest advantage. If you're closer to retirement or you just sleep better with stability, flip that around. Put 60 or 70% into FSTA and FHLC and let growth play a supporting role instead of the lead. The goal isn't perfection, it's starting and then sticking with it. Another big mistake people make is investing everything at once and panicking at the first downturn. And let me be clear here, the market will drop, not might, will. At some point, your $100,000 will look like $85,000. Maybe $75,000. That's not failure. That's just what investing looks like in real life. The people who win are the ones who expected this, didn't freak out, and either held steady or kept buying when things felt uncomfortable. That's where dollar cost averaging comes in. Instead of dumping all $100,000 in on day one, you spread it over 6 or 12 months. You invest a fixed amount regularly. You'll buy more when prices are down and less when they're up. It might not maximize returns in a straight-up bull market, but it does wonders for your sanity. And here's the real separator between people who build wealth and people who just talk about it. Automation. Set up automatic investments, make it boring, make it forgettable. The less you touch it, the better your results usually are. Because touching it usually means panic selling at the worst possible time or chasing whatever just had a great year. When you don't automate and don't stay disciplined, here's what happens. You check your portfolio too often. You see red. You read a scary headline. You convince yourself this time is different. You sell. 6 months later, the market's higher and you're sitting in cash wondering how that happened. Staying invested is harder than it sounds, but it's the only way this works. Here's the real takeaway. You don't need to predict the next hot stock. You don't need to trade constantly. You don't need to outsmart Wall Street. What you need is exposure to productive businesses, low costs, diversification, and time. These 5 Fidelity Index funds give you exactly that. Some protect your downside. Some fuel your upside. Together, they create a portfolio that can grow quietly while you live your life. And that's how real wealth is built. Not with excitement, not with hype, but with patience, consistency, and letting compounding do the heavy lifting. If you nodded along to this, hit subscribe and send it to someone who's stuck in the grind. We need less flexing and more honest money math. Stick around. We'll keep breaking down the traps and the boring moves that actually buy freedom.